gotta leave your money behind you. Raise your hand to...
Welcome back to Give Me Some Truth International Edition. And actually, normally, I drop in a little Portuguese, a little Spanish, a little French. We don't need to because we are focusing on an international destination where the joke is, separated from the U.S. by a common language. We're talking about moving to the United Kingdom, Great Britain, Northern Ireland, Wales, or Scotland. Quite popular destinations for our clients for a variety of reasons, and we're going to be talking about we're updating a blog piece that we have on kind of 5 things related to that. So we're going to focus in on kind of the key points from that blog piece. I'm joined by my colleagues Sil Michelin and Stan Farmer, both of whom have
Hello, everyone.
significant experience working in this area, and Stan actually updated the blog piece, so we'll kind of turn it over to Stan to get things kicked off by, where should we start if, I'm an American moving to the UK?
Yeah, I mean, it's a great question. I mean, first of all, I mean, there's some great advantages for Americans moving to the UK. You identified one of them, the language barrier is semi-lifted, right? It's just a matter of not adopting a fake British accent. Please don't come to us if you've already adopted a fake British accent. Or come to us and we can help in that respect as well. But no, I mean, in all seriousness, there's advantages in being in a country that has the quantity of Americans that the UK has, right?
Right.
And part of that is getting like accounting and legal help, okay? And obviously finding, groups and affiliations and friendships and all of that, right?
Yeah.
One of the disadvantages, I would say, is that all of those talented professionals that you can find there to hire to help you with taxes and estate planning and things like that, you're probably going to need it because there's just a sophistication and complication that comes with common law, right? And so between the U.S. and the UK, you have common law and all its vagaries and all of its complexities. And then on top of that, then you have tax laws that I would say when it comes to rules and regulations and actual code, the only thing out there in the world that might compare to the United States of America in terms of complexity might be the HMRC, which is the IRS equivalent of the UK equivalent of the IRS, I should say, Her Majesty's
Revenue and Customs.
Their rules and IRS revenue rules, right, and the code itself. Right.
Well, and never mind, and we can talk about this more because, I do think the U.S. and UK have a pretty good treaty still, but one of the other things to consider is you have 2 different tax years, which is kind of unique to the UK.
Another valid point.
Yep. The tax year in the UK starts on the 5th of April, right?
6th of April.
6th of April and ends on the 5th of April.
Yeah.
Careful.
And this is like a Justinian Gregorian calendar dealy. So there you go.
But otherwise, you're right to point out that the UK-US tax treaty is probably one of the better treaty that we have with any country around the world. One of the more detailed, with the exception maybe of Canada. The UK is one of the more kind of structured and more detailed. So that will play in your favor, and that's part of the whole,
That's where Americans are, right?
That's where Americans are, exactly.
Canada and the UK.
And there's a great community of expats, and there's a great community of very good, talented professionals in the accounting and legal field that are there to help you. And so there's an interesting aspect to being an American and being a foreigner broadly in the UK, and that's that distinction between being domiciled and being a resident. So maybe as a first topic, we can kind of start talking about is this whole idea of moving to the UK,
right,
but not truly being a fully fledged domiciliary of the UK for tax purposes, and what are the implications of that?
The income tax side of that, and then we can talk about the estate tax side of that,
Yep.
right? So those are 2 of the 5 points in the blog that I wrote about 5 top things you need to know before moving to the United Kingdom, because I really think that there's got to be 100 things that you would benefit from knowing, but these are the 5 most critical, and it gives you a good sample tasting, I think, of why things are more complicated than it might otherwise seem to you just moving across the Atlantic.
So on the income tax side, we start with the idea of how you can be taxed, and this process covers your first 7 years. You can choose kind of automatically, and then after 7 years, you can kind of pick which method with a what we'll call a kicker to the UK. You can after that 7 years, you're allowed to pick, but essentially the first 7 years you're taxed on either the arising basis or the remittance basis. And so very quickly, Stan and Sil, you want to lay out what the difference is between the arising basis, the remittance basis, why one may go with one over the other, and then we can kind of take it from there, because that has effects on your investments as well.
Go ahead and describe the differences, Sil.
Yeah, well, so the first thing we need to start with is just explaining that it is possible to be a resident of the UK, but not be considered to be domiciled in the UK.
Right.
And if you move to the UK, you're going to keep hearing this idea of being a resident non-domicile. So this is the idea that you're moving to the UK, but you are not a UK citizen. Your parents weren't from the UK. So you are effectively there, but it is not truly your nationality. It's not, and this idea it's a common law concept. It isn't actually a tax concept, right? But it has tax implications in the sense that it gives you the ability to elect to be taxed on a remittance basis as opposed to an arising basis of taxation, right? So, and we're talking about income tax here.
Yes.
And the idea here is that you basically make an election. Effectively, you tick a box and you say, I'm a resident of the UK, but I'm not domiciled in the UK, and I elect to be taxed on a remittance basis. And what that means is that you'll only be subject to UK taxes during your first 7 years of in the UK on money that you send into the UK, that you remit into the UK, plus any income derived from the UK, for example, in the form of employment, right?
So let's say I have a U.S. brokerage account and I elect to be taxed on the remittance basis, and I don't move any of that money out of that U.S. brokerage account, I won't be taxed on it in the United Kingdom, correct?
Not in the current year when you receive it, and not at least for the first 7 years of your stay in the UK. That's correct. As long as
Until you
don't
bring it over.
Until I bring it over. And so this gives rise to one of the planning considerations, right? Because a lot of folks, they are, the sort of default is if you move to the UK, go on the remittance basis, right? And keep your assets outside of the UK. Now, in the case of if you're moving from a lower tax jurisdiction, and part of the reason that there is after 7 years the ability to pay and get this is for folks who are in lower tax jurisdictions. But if you're coming from the U.S. where the tax jurisdiction may be similar, one of the planning opportunities is to think, am I going to be buying a house in the U.K.? And how will I be funding that house purchase? Or will I be making other large purchases in the United Kingdom? And how will I be funding those? Because what happens if I remit money, I'm on the remittance basis, and I remit money to the UK, what goes on then?
it gets complicated.
Very quickly.
Oh, so terribly complicated.
Yeah. Because then you have to determine if any of that money was previously untaxed income that you collected while in the UK. And it just gets very messy. You have to start looking at what they call ordering rules, et cetera, et cetera. So it gets really complicated. And so I would say, and you're right to say that a lot of people who move to the UK by default will elect for the remittance basis of taxation, because intuitively it's like, oh, I don't have to pay tax. Why wouldn't I do it, right? But I think if you're an American, it's a little different because it's not like that money will be untaxed. It will still be taxed in the U.S. in any case. So it's not like you're getting tax-free income. And also, if you end up staying in the UK longer, and if you have to make large purchases domestically, like buying a house, then you have to start really worrying about where did the money come from? Is it going to be a big tax liability? So and we see that a lot. We talk to people who moved to the UK. They thought they were moving there for a couple of years, and they're still there 5 years later, and they got married and had children, and now they want to buy a house, right? So you have to be very careful, and that's probably the first big decision, right, that you have to make when you're moving to the UK is, am I going to be taxed on an arising basis or on a remittance basis? And certainly it's part of the work that we do with clients who come to us and say, look, I want to move to the UK. I'm planning ahead. It's going to be one of the important considerations.
Yeah. Because one consideration, too, is that you can move money there before, you've moved, right? You can move cash there and, that you set up your bank account, you move the cash there.
True.
It's not, taxed in quite the same way, and you avoid some of these issues as well. If you, decide you're going to go on the arising basis and you're going to sell some stocks, it gets easier to track and so on and so forth from a perspective of what's my tax obligation in the UK. And in certain cases, ironically enough, you can be in a lower tax bracket in the UK on capital gains than in the US because they have a 10 and a 20 bracket. Right. And as an offshoot to this, it also, I think, the idea of remittance versus non-remittance also speaks to what kind of investments you have and how those investments will be taxed. Stan, you brought up the idea earlier of, HMRC rules. You have, in the United States, you have PFICs, passive foreign investment companies. Sorry, yep. The C was blanking. And in the UK, they have a similar sort of set of rules, right?
Right. They have rules that like the PFIC rules, take away your capital gains treatment from the income derived from offshore funds. And offshore funds from the UK perspective, obviously, is anything that's not registered in the UK, which would include all US registered mutual funds, ETFs, hedge funds, private equity funds, etc.
If you're in the UK, the US is offshore. It's like the old joke about, Budweiser being an imported beer if you're in the UK. It's very fancy. You get your Budweiser there. So, Stan, this presents another planning opportunity, right? If you're on the remittance basis for the first 7 years, that gives you 7 years to, in some sense, get your house in order, right?
As long as you're not remitting, right?
Yeah.
I mean, again, that's the thing. I mean, look, if it gives you the opportunity to kind of fix your reporting fund issues, but never remit that money to the UK if you do, okay? And one thing I think we've got to really, revisit here on the remittance thing, just to kind of put a pin in it and like reinforce why this can be such a critical thing, is that technically you could be on the remittance basis for years, go on the arising basis, and then remit money from way back when, and literally end up in a situation where you're being taxed twice, right?
Yeah.
And I mean, it can be horrible outcomes. So while the remittance basis may work in these situations where, hey, I'm on work assignment. My law firm assigned me to the UK for a while. I think it'd be a great experience for me to do the corporate work here or whatever, et cetera, et cetera. But I've still got my US portfolio, and I'm not going to change it, right? I'm not going to, sell my SPY holding, which is the largest US ETF, and yet is not a reporting fund in the UK, right? Gives you a chance to the remittance basis allows you to continue on, as it were. But don't ever remit that money. And if you decide, if your plans change, you fall in love when you're in the UK, and you end up staying, and you end up being a domicile of the UK, just understand that this has created additional complications, tax complications in your life, and you have to continue to incorporate that calculus into your planning thereafter, right?
One thing that maybe we should make clear for listeners are what are reporting funds still, because this is a term that we throw around, but is very crucial for your investment portfolio if you're living in the United Kingdom.
Sure. So all funds that are registered in the UK, so UK funds are by default reporting. They comply with all HMRC rules, and you automatically get capital gains treatment when you sell them. Now, what about foreign funds? So from a UK perspective, what they call offshore funds, which would include all US mutual funds and US ETFs, right? Well, for offshore funds, they will get capital gains treatment in the UK only if they are on the approved list of HMRC offshore reporting funds.
Right.
And that means that basically the fund company has gone through a process and is going through a process annually of making certain disclosures to HMRC, and that allows them to be on that list. That list is public. Anyone can go on the on Her Majesty and Customs website and download the list. And
It's a giant spreadsheet.
It's a huge spreadsheet.
So make
Giant
sure
spreadsheet.
before you download it, make sure everything
Clean up your hard drive.
Yeah, clean up your hard drive, all of that.
But so for an American, obviously, this is a good opportunity to remind people that probably one of the golden rules as an expat is be careful. Don't buy foreign mutual funds and ETF as an American, because then there's PFIC rules, right? But so if you're in the UK, so that means you don't want to buy UK funds. So you're going to continue to buy American funds, but then you want those American funds to still be tax efficient in the UK. Yes. So what you need to look for are US funds and ETFs that make the proper disclosures to HMRC and are therefore on that list of offshore reporting funds in the UK.
And we're intimately familiar with that list. There are a couple of mutual fund or ETF companies, because there are fewer and fewer mutual funds that are on that list. A couple of ETF companies that report. Not all of their funds, though, not all of their ETFs are necessarily on that list. So you have to be careful. And there are certain things that you can do as well to get mutual funds transferred into ETFs that are reporting funds and so on and so forth. So it's really a big sort of planning opportunity. This is supposed to be a kind of overview of some of the issues, so we don't want to go too long on any one topic. But one of the other areas where this idea of domicile and residence and all that comes into play is an area where, Stan, you're pretty familiar, and that is with estate planning, IHT planning. And confusingly, they have, much like the U.S., an estate tax, which means it's the person who dies gets taxed, but they call it the inheritance tax, the IHT.
Right.
And so what's a little bit different there, and how does domicile and residence play into that?
Okay, so the most important differentiator between U.S. estate tax and UK IHT is that you don't have to be pretty rich if you're domiciled in the UK to have estate tax exposure. Not at all, right? Whereas right now we have about 12 million per individual exemption from the U.S. estate tax and the U.S. gift tax, right? IHT and gift tax work entirely differently, and you have essentially, assuming that you have a home that you own, each individual has something akin to £1 million exemption, which would be like 1.6 million. So it's a fraction of the U.S. exemption. And IHT,
less than 1.6 million USD right now.
Yeah, less than 1.6, like quite a bit less now, right?
And if
you can tell I've been doing this for a while. Like my go-to exchange rate is 1.6.
And the other thing there is, if you don't have a house, it goes down to essentially £300,000, or I don't know, what are we talking now? What is that, about 420,000 back of the envelope?
Yeah. US
dollars, something like that. Now, and we say this, disclosure, the dates could change. You could be listening to this at a different time. So maybe Stan will be correct.
Yeah, no, I mean, but let's just, the important thing to remember is that if you move to the UK and you become a domiciliary of the UK, then you're probably subject to IHT on your worldwide wealth transfers, right? And that's a big thing. So it is, one of the rules that foreigners try to avoid is IHT, and for good reason, right? So becoming a domiciliary of the UK is a very significant thing, and unfortunately, it can be a very subjective thing, right? So I live in the UK. I've lived in the UK for 7 years. I rent my place. I'm on an assignment with my law firm. Am I domiciled in the UK? The short answer is I don't know yet, right? Add some other things. I don't own a house in the United States either. I'm married to a British lady. We have kids. They all have UK passports. I've never made, any affirmation that I intend to return to the United States. I don't know. I mean, it's very subjective, right? And people are always trying to avoid it. So they'll always say that they have no intention if you ask them their intention, right? Because of the subjectivity of it, that intention is wholly relevant. It's like residence plus intention is essentially what domicile is. So the UK, the HMRC, has created a deemed domicile rule. But think of this as the outer boundaries of how long you can pretend to not be domiciled in the UK while living in the UK, right? And those rules essentially are that if you've lived 15 out of the past 20 years, or you go through a 15-year period out of 20 years at any time, you have become deemed domiciled in the UK, despite any intention otherwise. So it's an outer boundary number, okay? But if you move to the UK, you get married, you buy a house, you raise a bunch of, kids, you send them to UK schools and, so on and so forth, or, obviously you apply for citizenship, right? These types of things, right? It doesn't mean that you get 15 years before you're subject to IHT. Wrong. I mean, it means that you probably, can very quickly cross the threshold and become domiciled and therefore subject to IHT. So understand that there's a limit, that if you really want to avoid IHT, you get out of the UK before that you cross it. But there's also, lots of things you can do in the meantime, before that point where you've triggered domicile. And you may or may not know it, but you need to be cognizant of the possibility. And so one thing that, some law firms that work with a lot of international clients in the UK will do before they start, meddling with wills or, anything else, trusts, etc., is they do what they call a domicile audit, right? And it's like a questionnaire. And then they try to put on the white wig and play UK judge and try to determine whether or not, they think that you've hit the criterion, or if there are changes that you need to make right now because you're skirting on the outskirts of domicile.
And it is a little bit more bleak than the U.S. in terms of where the tax limits come in. But there are, a couple of things that the U.S. also have that the U.K. will have, one of which is you can pass assets to your spouse without any IHT, which is nice. It gets more complicated when you start passing assets to your children, either in the UK or not in the UK, and that's kind of where that jumps off. We're bumping up against time. I think we've got more material that we can cover. In the interim, hopefully we'll turn back to this subject. In the interim, we encourage you to check out Stan's blog piece, which is entitled 5 Things to Know Before Moving to the United Kingdom. Is that correct?
I think that's more or less correct.
Yep.
It is now.
And check that out, and we'll say, we'll talk to you again soon here at Give Me Some Truth International. I want to thank Stan and Sil for joining me, Keith Poniwas. And if you have any questions, any concerns, feel free to reach out to any of us. All of us have, as hopefully you've gathered here, significant experience working with folks in the United Kingdom, and remind you as well how many countries are in this country.
How many countries are in this country?
Yeah. So thank you for listening, and take care. Bye-bye.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.